Hello, this is Jonathan, and in this video, I'm going to teach you, show you, and inform you on how to buy gold and silver. You're also going to learn where to store it, if it's physical, and what to do if you're buying digital versions of it. Now, I'm going to break this video down into 4 parts, and I'm also going to edit this video in a way that's going to reduce a lot of the white noise and try to make it as condensed for you as possible. Now, in the first part of this video, I'm going to give you a bit of a history on gold, where we've come from and where we are today. Then in the second part, we're going to take a look at buying physical gold versus electronic gold and gold contracts. And I'll also make mention of some apps that I use where you can buy electronic gold. This way you can get an idea on everything that's available to you today. And in the third part, I'm going to walk you through the process of actually buying gold and silver. And in the last and final part, I'm going to discuss some elements that move the price of gold and silver. So just consider this a great place to lay the foundation if you don't have any prior knowledge. And hopefully you're going to walk away with some brand new information that you didn't know before. But before I get into this video, I do have to tell you that, look, I'm not a licensed professional, I'm not a licensed advisor. So everything that you're going to hear from me today should just be considered as educational material only. And if you're intrigued or want to learn anything more about what you've learned in this video, please just make sure that you speak with a licensed professional before you do anything silly. Okay? Before 1934, the price of gold flatlined at around $20.67. Old school thought had it that if there was $100 in gold in the reserve, there could also be $100 of currency floating around. If you wanted to expand the currency supply and take it from $100 to $150 without debasing the actual currency, well, to do that, you actually had to increase the amount of reserves you had in gold. This is traditionally known as a gold-backed currency. Now, gold-backed currency in the US isn't a new concept. It was way back in 1787 that the US Constitution laid out plans that would deem gold and silver official currency of the country. Then World War I happened. Now, you may remember just a moment ago that I mentioned that on a gold-backed currency, the idea was that you could not have more currency in circulation than you had in gold in the reserves. But during the World War, money had to be printed to pay for that war. And this new money was backed by nothing. So now we have, in this hypothetical example, $100 worth of gold in the vault and over $1,000 in currency that is circulating around. Alas, we had a problem. And after the World War ended, many countries tried to go back to the old gold standard. And yes, that was at the same price of $20.67. Now, as the Depression of 1929 to 1932 tore through the US, some changes had to be made. In 1933, Franklin Roosevelt unpegged the dollar linked to gold. This meant that the US could print more money and not be required to service that extra currency with an equal amount in gold. The new price of gold, however, shot up as soon as this order was signed, $32.32. It was effectively revalued. Now, the reason for the increase in the gold price could have been to take into consideration the new currency in circulation. And then what happened in 1940 was World War II. Now, with any war, I guess you can see what's happening here, that we needed more money. And they needed to do that in a way that wouldn't destroy the current economic system. So fast forward a few short years and another war or two, and then America, Canada, Australia, Japan, and a bunch of other Western and European nations, they thought it'd be a cool idea to introduce a brand new system. Now, this system, to any academic student today, is called the Bretton Woods system. And this system was pretty much a modified version of the gold standard, but it relied on the trust and faith of the US that the US could cover its debt obligations with gold. Well, that's in a nutshell anyway. Now, just like the old system, the new system, the Bretton Woods system, had a new value for gold. Now, gold was no longer valued at $32.32. Instead, it shot up and hit $35. Now, unfortunately for the US, though, their gold holdings started to shrink compared to the national currency. And in August 15, 1971, Richard Nixon said, "Screw this, we're leaving the gold standard, we're unpegging our currency from this archaic system." And alas, the gold standard was ditched and gold was free to trade at whatever price it wanted to. Of course, this is against the US dollar, but you get the idea. Now, throughout all of history, it's been proven that if you print currency indefinitely, it can lead to high inflation or hyperinflation. Think of Zimbabwe. What we've got now, though, is an economy with relatively low inflation and in some cases stagflation or deflation. I guess we could agree with Alan Greenspan when he said, "We can guarantee cash benefits as far out and as whatever size you like, but we cannot guarantee their purchasing power." Now, if you don't know who Mr. Greenspan was, he was the former chairman of the Federal Reserve, so you can see he was a pretty powerful bloke. Anyway, the moral to this message here is that gold was always valued in US dollars at a rate that could justify the currency in circulation. And at the time of creating this video, gold is around $1,900 per ounce in US dollars, and it's way higher in Australian dollars. I guess you could agree that we've come pretty far since gold was trading around $30 less than 100 years ago. But it does go to show the relative long-term performance of this market and how gold may, just may, provide a hedge against inflation, albeit slowly. So let's move on to point number 2. Now that you have an idea of where we've come from and where we're going to. In this section, I'm going to briefly discuss the various ways in which you can buy gold, and then some of the pros and cons of each of these ways. I won't go into too much detail, but I'll give you, the foundation. I'll start off with physical gold, and then I'll move down a list through gold explorers, gold ETFs, gold futures, and then fractionized or even tokenized gold, which we can buy today. And from here on out, when I discuss gold, I want you to interlock silver with this too. Both these metals, for the most part, go hand in hand. And like you can buy physical gold, you can buy physical silver in pretty much the same fashion. So let's break this down. First up, why would you buy it? Second, how are you going to store it? And thirdly, are there any disadvantages of this way to investing? Now, the main reason why investors buy physical gold is to bypass the system. A system, I mean the cashless, the digital, or even trackable system that we have today. Of course, this isn't the only reason why you'd buy physical, but if you take a squiz at any online forum about buying gold or even silver, there's always one nut out there who will tell you that this is the reason why you need to add it to your portfolio. And I have to admit, this is the exact same reason why I started a decade ago. They said, though, when it comes to gold and silver, you cannot hold it, you do not own it. But as time went on, I fell in love with the collection process, and adding more ounces or ingots to my collection became more of a hobby than a quest to remove my money from the system. But that's all history now. But as you can imagine, buying the physical metal comes with another layer of responsibility, which brings us to point number 2. Where on earth do you store it? Now, like point number 1, point number 2 will depend on who you talk to, because you can get as creative as you want with point number 2. If you're like me though, you might opt for a safe at home or even potentially a safety deposit box. Now, the safe at home, as you can imagine, would be the simplest. It's under your control, which means you know where it is. But the risk of this is that if anyone else finds where it is, well, you could risk losing your metals. The second option though, if you don't like that option, is a safety deposit box. But there's also risks to that too. What happens if the banks close? Either way, these are somewhat safe locations to store your gold, and a lot of people follow these two options. If you're a creative thinker though, then the world is your oyster. You can store gold and silver in the walls, under the ground, in the basement, in the attic if your house has one. You can even store it in your car if you wanted to. As I said, the list goes on and on. It really just depends on how creative you want to be with this process. What about cutting a hole inside a tree, like a squirrel's nest, and then stuffing your holdings there? The options are really endless, but you get the idea. Anyway, that is physical precious metals. There's not much to it when you buy it. All you need to do is decide when to sell it. And then before you do that, you just need to then have a plan on where you're going to store it. Now, the next way to invest in gold and silver is by investing in companies that mine these metals. This can be companies like ones that you can find in the Australian Stock Exchange, or potentially various exchanges around the world. Now, it just should be pointed out that you don't actually own the gold of these companies that they mine. But what you do, however, is participate in the growth of the company as they explore, mine, and then sell these metals. There is one thing you should know about mining companies though. Most of these mining companies that you'll find on these exchanges are explorers, and the majority of these explorers never amount to anything. So you may want to do some research before you back any dud company. You could just say it's often easier just to invest in an already producing company. These ones would generally do the best when the value of the gold price or silver prices increase. And as that price increases, supply and demand for that company goes up, because that company can then sell that gold for a higher value and you profit from that. So you're essentially just writing the value of gold in a different way. There is one thing you should know about buying these sort of companies though. People who are attracted to these sort of ideas and not buying the physical gold are generally ones who like to have a higher risk, high reward bet. They like to bet everything on one idea, and this might not be the best thing for you if that's not the type of person you are. And if you're not really into these high risk, high reward options, then perhaps you could look at an ETF. You see, an ETF is an electronically traded funds. It tracks the price of an asset or a basket of assets. As with any sort of ETF though, there is management fees that you pay. And you'll pay these monthly, quarterly, or yearly for this privilege of investing in this basket of assets. With gold, however, you can buy into a fund that has gold in a vault, and all you need to do is simply ride the fund's value up and down as the value of that gold in storage increases or decreases. So you become a beneficiary of the gold price, even though you don't actually hold any of the assets. But like saying before, you might want to just remember the phrase, if you don't hold it, you don't own it. What you're doing here is buying somewhat of a paper contract for this gold. You're not really owning the physical metal. And that kind of defeats the purpose of buying gold and silver. though it is an option you can take. There is an advantage to ETFs though, and that is their liquidity. You see, you can buy and sell these ETFs through your broker, and you can do this at market, which means that if today the price of gold is trading at $100, you can buy a $100 lot. If tomorrow it's trading at 112 and a 12% increase, you can sell it for that at market the very next day. You don't need to worry about anything. It's simply done through your broker. If you want to compare that with owning physical metal, well, you need to pay a few visits to your dealer, which can take time and could result in some unnecessary paperwork. So just get an understanding of how those two work. All right, so far we've covered physical, we've covered ETFs and also gold mining companies. Let's talk about futures briefly. You see, futures are a little bit more complicated. They're usually traded by professional investors, but you can and do have the ability to do this if you have the right broker. In short, a futures contract is a legal agreement to buy or sell a particular commodity or asset, security as well, at a predetermined price at a specified time in the future. Of course, as I said, it's slightly more complicated than just buying a share in ETF, so I won't go into too much detail on here, as we'll be here for quite a while. But just know that if you do decide to buy a contract or parcel or a lot of gold via the futures market, you may be buying a margin, and you may also be liable to take delivery of it if it expires and you haven't sold it before then. So be careful here. As I said, it's not the same as an ETF, and a fat finger move on your keyboard could have you buying a lot more gold on margin than you first bargained. The benefit of these futures contracts, though, is that you can profit from the rising price and the falling price of gold. That means you can profit as the gold rises, you can go long, and you can profit as the gold falls by going short. So you do have a lot of flexibility here. So now we have our final item on the list, and that is buying tokenized or fractionalized gold and silver. In Australia, there are two main ways. So not only two, but just two main ways, which I'm going to talk about today, which you can buy fractionalized or tokenized gold and silver. Now, the first is via Perth Mint, and that is through their Perth Mint Gold Token, or PMGT for short. PMGT is the first digital gold token on the public blockchain that is being backed by the Australian government. Each gold token you buy is backed by a 1-to-1 in gold in its vault. So a very simple example is if you pay $10,000 for these tokens, then Perth Mint have said, backed by the Australian government, we will host $10,000 in equivalent gold in our vaults for you. If one was to use this method to buy gold and silver tokens, the Perth Mint created the Gold Pass application, which can be downloaded to your mobile phone. Perth Mint has said that the Gold Pass is the Perth Mint app, which allows investors to instantly and securely buy, sell, transfer physical gold via digital certificates that are 100% backed by physical gold in the Perth Mint. Now, there are some pros and cons to this, obviously. First up, just so you know, Infinigold is the issuer of the gold tokens here. All that means is that these tokens are issued over the blockchain, which is still a relatively new technology and still being developed today. That's primarily the most important con, though I definitely recommend that you check out Infinigold and PNG because it seems to be that the benefits definitely outweigh the cons here. So if you're interested, just go to pmgt.io if you want to learn a bit more on this. The second tokenized or digitalized gold and silver offering, which I will discuss here, is one offered by Ainsley Bullion. Now, I have been shopping with Ainsley since around 2010, and I also own some of their products, two in fact that we're going to talk about now. I just thought that this warranted a disclaimer. Ainsley offers digital tokens which have been fully backed by the physical metal. You can buy AUS or AGS. Now, AUS sounds like Australian silver and AGS sounds like Australian gold. But try not to get these confused. You see, AUS is the digital token for gold and AGS is the digital name silver. This product offers similar features to Perth Mint's offering, but you can also buy this on exchanges like CoinSpot, Metex, and through Ainsley Wealth themselves. So pretty much, you don't just have one platform to buy and sell these on. When buying or selling these tokens, you'll be buying generally gold or silver per token. And one token is the equivalent of 1 gram of that particular metal. The good thing about this one though is if you save up enough tokens, you can actually redeem these for physical precious metals. So 1,000 AUS tokens can be redeemed for 1 kilogram of gold, and 50,000 AGS tokens can be redeemed for 50 kilograms of silver. Of course, which route you choose to go is yours. I use these roundout apps to buy these, and the service I personally use is called Bamboo. It's like any other roundup app on the market where you spend money each day or each week or each month, and it rounds up a fraction of that. And at the end of the month, if you've met a certain threshold, it then takes money from your bank account and deposits it into the investment account. For me, kind of an issue if I'm spending a lot of money, because then I'm going to be having a huge chunk of my money ending up into my investments accounts, which simply means that the more I spend, the more I save. So it can be, it's a bit of a trade-off there. But as you can see, the options that we have today are very different to when I first started investing in gold and silver. And I seriously mean it. You see, a decade ago, I would go to the bullion dealer every 2 weeks, or if I was waiting for a hefty commission to come through from a sales job once a month. And then I would line up, go through the security checkpoints, enter, select what bullion I wanted from the list, and then I'd have to awkwardly carry this home without trying to be mugged by someone. And if you're, taking $5,000 of bullion home every couple of months, it can become quite a tedious task. And to repeat that every few months or every few weeks over a couple of years, digital tokens and things like that are pretty cool. And I just use Bamboo. It's a simple way to invest. And with Bamboo, I have the option to sell my investments as tokens or have the cash sent to my bank account. But if I'm in it for the long term, well, I can continue to invest and I can save those 1,000 tokens of gold and 50,000 tokens of silver and redeem them for the physical metal. And I didn't have to have any storage issues until I actually had the ability to redeem them in full. All right, so that's part 1 and part 2 sorted. I really do hope you're getting a lot of information and still being able to follow along in a relatively simple way. What I'm going to do now is move over to part number 3 of this mini video. I'm going to show you how you can buy physical bullion and the process that I take. Now, I've already introduced you to Ainsley Bullion, so it just kind of makes sense to use them from here on out. And in my opinion, they're the easiest, they're the simplest, and they were the most welcoming when I started investing a decade ago. But you can use whoever you want. I'm not here to tell you, I'm just here to show you the process. That way, when you want to go out to the market and do this yourself, if you want to, you'll be able to do this on your own terms. The only caveat I have here is to buy from a dealer. Don't buy precious metals from an art dealer or anyone who sells art, coins, medallions, guns, and so forth. You want to be buying them from a precious metal dealer. The reason for this is because I found that these guys, these art dealers, tend to have the highest premiums on their bullion, which can result in an unnecessary expense on your portfolio. And if you don't know what premium is, that's okay, because I didn't once upon a time, so we'll discuss it now. You see, the very first time that I bought precious metals, it was 6 times 1 ounce silver bars. I bought it from an art dealer, so I'm telling you why not to do it. But you see, I didn't know a lot back then. I thought I knew a lot, but I actually didn't know a lot. So you're going to be learning from my mistakes, okay? You see, now let's discuss premium. Premium is an added cost, and you're going to pay this cost no matter what, added on top of the spot or strike price. The simplest way for me to do this is to give you an example. Let's say that silver is trading today at $30 an ounce, and you want to buy 1 ounce. You have a few ways of buying this 1 single ounce. You can do it as a bar, as an ingot, and potentially even as a coin. You have the choice there. Now, the ingot is usually going to be the cheapest. And the reason why it's the cheapest is because it's easier for these factories to ship it out. There's not a lot of workmanship required, and it can be spun through the refineries at a really high rate. Pretty much just stamped in the refinery. Put them in a little cask. One at a time, and then they just might give them a light stamp. The second is the bar. Now, the bars are also stamped, but the bars generally need a special cast, and you're going to have to pay for this. It's not as cheap as the ingot, but it's cheaper than the coin. As you can imagine, the coin is going to be the most expensive of this lot, and that's pretty much because coins come in multiple forms. You can get standard coins like we can get from the Perth Mint, or you can buy luxury coins like the ones you're going to find at Australia Post here in Australia. Either way, the thing that you got to remember at premium is that the minimum price you pay for a coin is the coin's strike price or spot price plus premium. The premium in a nutshell is the workmanship, the art, the processing, and also the dealer's profit. It's everything on top of the strike price, and that way everyone is getting a profit at the end of the day. Now, this can range from a few dollars depending on what coin it is to a few $100s if you're investing in the luxury market. You do have to pay it. There's no way around it. You're going to be paying it on top of the strike price or spot price. On the flip side though, now that we're talking about premium, what you're going to pay when you buy, you're going to lose a clip when you sell. You see, the dealers that buy silver off you are going to take a small cut of that bullion in a dollar value, give it back to them. So a silver in this hypothetical example has a spot price of $30. You might get $28.50 per ounce. So you're going to lose on the way up if you're buying, and you're going to lose on the way down if you're selling. Something to keep in mind. All right, so now that you understand premium, you understand coins, bars, ingots, and blah, 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 I'm now going to jump over to Ainsley Bullion's website. I'm going to show you the process that you can take to buy gold and silver. And we'll also discuss the various price points. You understand everything now, so you'll know what to look for and what to not look for, and how it all sort of fits together. Alrighty, so I've just switched over to the computer, and I'm now going to walk you through how you can research price and also place buy orders with Ainsley Bullion. As I said, Ainsley, who's I use, you can use anyone else out there I'm just going to give you the method and then you can repeat this process elsewhere. Now, as you can see on your screen right now, we just had a little banner pop up for Bamboo. Now, I've mentioned Bamboo a few times, and I actually found out about the Bamboo app through a Facebook ad, I believe. And then once I found out that they were associated with the AU and AG products that ANZ Bullion offer, it was really a no-brainer for me to just continue using ANZ Bullion products and have Bamboo as my method of investing into these products. Please don't sign up to Bamboo based on my recommendation. Do your own research. It's just who I use and it serves me. Alrighty, so I'm going to give you just a brief background on this website, and my intention is not to give you a full featured video on how to use it, but I'm going to just show you a few tabs and then we're going to make some buy and sell orders. Well, not sell orders. I'm going to make some buy and delivery orders for gold and silver. So we're going to click on the first button up here. It's called gold. Now, when you click on gold or when you click on silver, it's going to take you to the product page. If you take a look at the gold price and the silver price, let's do that first. We're going to get a chart here. So right now, this is gold AUD, gold USD, silver AUD, silver USD, and so forth. The one we're looking at now is gold AUD. Now, gold in Australian dollars is currently trading at $2,565 roughly per ounce. Now that we have that number, 2570, let's just get the green one, 2571. We're going to go over to gold and we're going to go down to 1 ounce because I just want to show you premium to start off with. So we're going to go through this list. We got 1 gram, 1/20th of an ounce, 1/10th of an ounce, 5 grams. So it goes bigger and bigger the further down you go. 1/2 ounce, 1 ounce. Okay, so, oh golly gosh, I forgot the price. 2571, I think it was. ANZ Bullion Gold. Let's open that up. This is an ingot, okay? And it's just being casted in a square and it's got a stamp on it for ANZ Bullion. And let's go down to this one. This one here is also an ingot. It's been casted in a square and it's been stamped with the Perth Mint. This one here is a bar. It's been casted in a rectangle and it's been stamped by the Perth Mint and it's also got text stamping on it. This one here is a coin and it's been stamped generally by the Perth Mint and these ones with an image. And this one is the 2021 Year of the Ox, or a Chinese coin. The reason why I'm showing you that, because I'm going to go back now to the gold price. I want to show you how, when I mentioned before, premium. So you're going to pay spot price. You can't get gold any lower than spot price, okay? So 2570. Now we're going to take a look at these gold. We've got 1, 2, 3, 4 1 ounce gold bars and coins. This one here is currently priced at 2626.02. Now 2626 is roughly a $50 increase on the actual spot price of gold, okay? Now that 2626 and that spot price of gold, that increase or that gap is what you call premium. It's the casting price, the workmanship, and it's also the dealer's premium. So by the dealer premium, I mean their profit. If we head over to the Perth Mint, we got 2631. So we got 2626, 2631. It's the same 1 ounce, but this time we got a different stamp from Perth Mint and the premium is higher. This one here, which is the bar, is 2656. So 2626, 2656. As you can see, all it is added premium. It's still the 1 ounce. I could take this to the market and sell it for roughly the same price on the secondary market as I could for this one, for a little bit of premium. 2706, so it's almost $100 more just because you're getting a coin. It's the exact same 1 ounce. So if I was to melt all of these down just into like a blank ingot, a blank bar, it is 1 ounce of gold. Nothing changes. The extra price here is the price of premium, and that's what you pay for. So when I first started out, I was buying a lot of silver, and I was buying these 1 ounce coins, 1 ounce bars, and then eventually I moved into buying boxes. So let me see if I can find boxes. Oh, got some of that. Do they do boxes? No, they're not doing boxes. You could get boxes of 100 coins at a time. So at the time, I think it was like maybe $45 an ounce, and you'd buy 100 of them and you just grab a few boxes at a time. So it doesn't matter what you're doing. Just know that the more that you go upscale in regards to the looks and the fanciness of the ingot or bar or coin, the more premium you're going to pay. So the more you're going to pay for the workmanship and the stamping and that sort of stuff. My recommendation, if you wanted to get started out and you didn't know where to start, just go bars and plain ingots. So if we compare this 1 ounce silver kangaroo to this 1 ounce koala, this one is $41. This one is $43. What you would do is you would just go the $41 one. If you were to compare this 1 ounce silver bar with this 1 ounce silver bar. This one is $43. This one is $44. Just buy the $43 one. You don't need to spend more on premium, especially if you're going to get 100 of them. So here's the 100 number, which I was talking about before. If you're going to get 100 of them, that could be quite a large difference. You could use that money to buy more silver for the exact same. And the further down you go, let's take a look at this 1 ounce silver gold gilded. We're looking at $104 for 1 ounce coin. This one here doesn't have any gold on it, but it's still a 1 ounce coin. It's $104. Why is it so much more than this 1 ounce coin? Again, that's the premium and that's the workmanship. So I hope you're starting to get an idea of how all this works and what you're looking for. Now, if you're curious, the price of silver in Australian dollars, look at that, is just $33, $33.37. So what I'm paying here is I'm almost paying $10 an ounce extra than what the actual spot price is. So there's actually a discrepancy right now between what the spot price is and what the dealers are actually charging. This happened in 2011 as well. Quickly, the price of silver catched up to match the pace or the value of these coins. But right now we actually have a $10 variance, and that's quite high. You wouldn't want to invest in this kind of market right now. You'd want to invest if this was like, if silver price was 33, this would be like 37. $41 is way too high in my opinion to be starting out looking to invest and adding coins. But depending on how much money you have, you don't want to be wasting your time going coins unless you're like some doomsday scenario thinker. You would just go straight to the kilo bars, the 100 ounce bars, and then the 5 kilo bars. That's where you'd want to spend most of your time. If you've got $10,000 to invest, you wouldn't get $10,000 in 1 ounce coins. You would move down here and probably grab 2 of these. Of course, just hypothetical example, but this is going to be generally the best value for that same amount of money. You're going to get more ounces, so to speak. Alrighty, so now that you've figured out what you want to buy, we want to buy one of these 5 kilo Ainsley bullion bar. All you're going to do is add it to cart. Now it's in that cart. I want to now check out. So welcome to the Gold and Silver online store. For orders over $5,000, we need to identify you. You need to get an online verification. If you're an SMSF or another entity, you need to complete this form. We're not going to worry about that. What I want to do is lock in prices and proceed. You see prices fluctuate all the time. As you can see, if we go back to the charts, prices are moving up and down. This is a 1 day chart, but if we go to 1 minute, you see prices are moving up and down. So you can lock in the price now. And then what they need is a 10% deposit, and then you'll get an email with instructions on how to pay the other part. But you have to do this within 10 minutes. You have to pay your 10% deposit in 10 minutes. So all you'll do now is fill out this information and then press confirm. The only thing you need to keep in mind though is that where are you wanting your gold sent? Store it in Ainsley's vault, deliver to the reserve vault, hold my order and I will pick it up from the shop, deliver to my address, deliver to my PO box, or this order is for a gift registry, which is like weddings and things like that. If you go deliver to my address, you're going to be set up with obviously your street address. And then if you go in and confirm, it's then going to, once you get the email from them, they're going to then send you the actual freight cost, which might be like $30, $40 to get it shipped out, depending on what you're actually purchasing. This is 5 kilos. I don't know what it costs to get 5 kilos shipped. I always pick it up, but it might be like $50 extra. So it's going to be, you go, oh, there it is. So $74.61, freight and insurance when that's tipped. So now you've got your full price, and then you pay 10% of that today, and you've got 8 minutes to decide what you're doing. All you need to do now, if I was to do this, is pay the 10%, wait for the email. Once the email comes through, I think I have 24 hours to complete my order. Once my order is complete, they simply just send it, generally I think it's FedEx or Star Trek or something like that, to my house, and it generally comes in less than a week, maybe like 3-4 days later. It's at my door and I've got my order. So that's how you use Ainsley Bullion. Take a look around yourself. You can navigate the price. There's some information on here on how to sell it back to them. Pick your dealer. You don't need to use Ainsley Bullion. This is just one that I've been using and I'm comfortable with, but really just pick someone you are comfortable with. And if you haven't made your first purchase yet, you now know how. Very, very simple. And you don't need to go to them. You don't need to walk into the shop like I was doing 10 years ago. If you're not comfortable doing that and carting it around, just pay the small fee to get it delivered to you. It's going to be it could be a negligible fee to pay in the future if these assets continue to rise. So something to consider. Yeah, I hope this helps. Let's get back to the video. Alrighty, welcome back. Now you know how to buy gold and silver, where to store it, how to sell it. You've got a pretty good foundation. To finish this video now, I wanted to take a look at some of the reasons why the price of gold and silver fluctuates in value. And in my opinion, there's going to be 7 ways this is reason, but we're going to take a look first at the 6 reasons which Investopedia has listed. And then on the 7th, you better stick around to the end, because this reason I believe is the most important reason and can really make every other single reason irrelevant depending on the situation. The 6 reasons listed on Investopedia are: number 1, central bank reserves. Now this is how much the central banks hold in reserve. The more they stockpile, taking supply out of the market, the higher the price of gold can go. You see, in 2018, governments bought 651 tons of gold, according to Bloomberg. The story was originally picked up because it was the most amount of gold purchased since the world ditched the gold standard in 1971. This also created fear in conspiracy land that the world might be heading back to some form of gold-backed currency. Guess we'll find out, see what happens with that. The second reason listed is the value of the US dollar. You see, gold is priced worldwide in US dollars. Locally, we value our dollar against the US dollar or a basket of currencies that relate to the US dollar. And when it comes to gold, our gold price is reflective of our dollar compared to other currencies. And when it comes to the US dollar, a fall in gold price can sometimes be due to an increase in the value of the US dollar, and a rising gold price can sometimes be due to a decline in the US dollar. Interchangeably though, the US dollar inflation level can also impact the price of gold, so keep that in mind. The third is jewelry and industrial demand. In 2019, it was reported that half the world's yearly gold demand was snapped up by the jewelry market. The World Gold Council put it at 4,400 tons of gold. That's a lot of gold. Point number 4 is the wealth protection element. You see, during times of economic uncertainty, think of events like 2008, 2012, 2015, 2016, 2018, and more recently 2020. During these types of events and periods, people turn to gold, and as a result of this can increase the demand and therefore rise in the price of the commodity. You see, gold is often looked as a hedge against economic events like currency devaluation, inflation, and a few other, which we've already touched on before. Point number 5 is investment demand. This is from people like you and I. You see, we're taking both physical and tokenized or electronic forms of gold off the market, and the more demand from investors, whether it's small folk like us or the big boys on Wall Street or even down at Collins Street, this can drive the value of gold up as more buyers start to outpace the sellers and price increases to reflect this new demand. Point number 6 listed is gold production, and this is clearly an important point. After all, should the production and supply of gold stop? Well, you can only guess that if demand stayed the same but supply decreased, we'd have the same amount of demand, which would then force prices to increase to catch up to the demand. All you need to do is think of an event to get an example of this, such as what happened with oil during 2020. When everyone was staying at home, the production or supply of oil remained the same, and we had an issue where the oil price completely collapsed. Now, if you're looking to get an idea of what would happen when the demand increases but the supply stays the same, just reverse that scenario. Now, those obviously are the 6 points listed by Investopedia, and these are usually considered as the most important and also agreed upon by most people. But what about point number 7 that I already spoke about? Well, point number 7 falls under what I would call an esoteric category. Esoteric simply refers to a topic that is intended for or likely to be understood by only a small number of people who specialize in a certain area or interest. And that simply means that what I'm going to talk about is not mainstream, but it does not mean that it doesn't work. In fact, this method is a method I use to pinpoint both price and time targets of gold in the future. And the 2 ways you can do this through this esoteric method is through both technical and time cycle analysis. Now, technical analysis you're definitely well aware of. It helps investors understand what happened in the past and use that information to forecast what might happen in the future. And this form of analysis usually involves understanding the price of an asset and how it moves or vibrates over time. And then once the analyst or technician has an idea of this and how it's behaved in the past, he will then try to move that into the future and get an understanding of what could happen in the future, and then pinpoint some certain price points where the price of an asset like gold would move from fair value to overvalued, and then reverse, or on the flip side, go from fair value to undervalued and then increase in price. Now, no doubt this sort of analysis requires some time, some skills, some patience, but anyone can learn it if you're willing to just put in the time to understand a very few simple strategies and techniques, and you'll be on your way to understanding technical analysis and using it. Now, the second part of this esoteric method is called time cycle analysis. Now, I use this every single day. It is by far the best, in my opinion, way to forecasting turning points, not only in gold, but in nearly every single asset class. Again, as I said a few times, this is esoteric and falls under that category. But some commonly use this time cycle research, and there's a theory out there which you may know of called the K-wave or the Kondratiev wave. Now, K-wave research cannot tell you the day or second that the market will change direction. And the reason for that is because this method or this K-wave theory stretches to around 50 years in length, and it attempts to pinpoint whether a particular asset would be moving through a bull cycle or a bear cycle. And then as the prices increases or decreases, this theory will tell you should you be long or short a particular asset class. Although this method is used today by a lot of traders and investors, Nicola Condrati was born in the 1800s and died in the early 1900s in 1938. And he died because of his research. He was actually murdered for what he knew. But his legacy lives on, and many tend to use his knowledge to this day. But unfortunately, I just cannot go into that much detail on that specific cycle analysis because it would require its own video or potentially even a full-blown course just to give you the scoop on how to use it. But there's one thing you can walk away with when it comes to understanding this esoteric theory, and that is something that W.D. Gann said. He said, when time expires, price changes. And from what I've seen, this is nothing but the truth. When a cycle turns, it doesn't matter how much you thought you knew about a particular asset or style of investing, the market must change direction. Now, it sounded like hoo-ha when I first came across this, but I did see this firsthand in 2011 when the cycle of gold was simply due to expire. It was up, and as a result, price changed. Now, I didn't know any of this cycle analysis, but I had to do research. And then once I learned about it, I was then able to have like a mini aha moment that this form of analysis is very powerful and it would serve you well to actually know it. Anyway, there you have it. You've got a bit of history on gold, how to buy it, where to buy it, and what form to buy it. 7 various reasons why the price of gold fluctuates, moves from high prices to lower prices, and how you can use all this to aid in your research in buying or selling gold and silver. Now, I hope you got a lot out of this video and potentially some insights you were hard pressed to find anywhere else. I just want to remind you once more that none of this should be taken as advice, just educational information. If you want to use any of the information that you've learned today, do some more research on it and then chat with a qualified professional, someone who is currently licensed. Again, this is Jonathan, and I look forward to talking to you soon.